Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome to the Risk Intel podcast. I'm excited to have with me today Tyler Pihl from Service Credit Union. Tyler has a background that I think is going to be particularly interesting today, having begun in the accounting and audit space, and then Tyler, right, having spent the last 10 plus years inside a credit union and putting, I think, a lot of those skills to use, and now moving into the risk space. So we're certainly excited to explore your journey a little bit. And then get into some conversations really around the cultural shift that you enacted there at Service. So Tyler, welcome. Great to have you.
Awesome. Thanks for having me. Glad to be here.
Maybe before we jump into the experience there at Service, maybe we'll just take half a step back for a second and take us through a little bit of your journey there, right from kind of accounting and audit and kind of up to risk. So maybe for our viewers, provide a little bit of that context to lay the foundation.
Yeah, absolutely. My background's in public accounting. I started my career there, got my certified public accountant license in that field, and then moved into the world of credit unions. So I've been here for over 10 years. I started in the internal audit department here at Service, moved up, oversaw that department, helped kind of build it out and establish it, and then moved into the enterprise risk management space. So it's been great.
Let's kind of pick up the story from there then, right? You moved into that ERM space there at Service. When you kind of made that step, right? What did you see within the enterprise risk team, and kind of what was the institution's perspective on why make an additional investment by bringing you into that team?
Yeah, we had an ERM department for a few years. It kind of went through, kind of fits and starts. There's a lot of departments and those that have ERM functions kind of focus on that top, bottoms up approach, and it really just becomes this behemoth to maintain and attribute, values to every sort of process and procedure. So we had gone through some change there, and there was an opportunity where, internal audit looked and said, hey, we can help kind of reshape this into something different. And really the idea was to leverage the relationships that we had established in the internal audit function as a value-adding department, and not just one that's, something that just takes and detracts from your time, right? Really focusing on how do I add value through this function. And by leveraging those relationships, kind of restarting the ERM function and saying, we're going to take the relationships that we have here, we're going to leverage that, and we're going to build an ERM function out that actually adds value, right? Not just meets the regulatory requirements and kind of, from a regulation standpoint, makes everyone happy, but something that we feel ties into our strategy and actually will allow us to achieve our goals. And right, to elaborate on that just a little bit is, I'm fortunate to be in the credit union space where we're naturally risk averse. Right. So we were also in this position where it's like all we have to do from a team perspective is measure the opportunities that exist in our organization already today and say, when we take risk, how do we measure it and then recognize that success or the failure, right, that comes along with it. But more importantly, the successes from that, right? You want to be able to say, I pulled this lever, we took some risk, here's what it resulted in, here's how we did it in a strategic and sound manner.
You've hit on a really interesting point there, Tyler, right? Which is that there's a DNA inside the organization and an inherent view on risk, right? Whether you want to call that the culture or the people, the systems, right? Probably all those things coming together. Your organization had a culture there. Would you say that, maybe describe that culture a little bit, when you were coming into that ERM space, right? What was the DNA of the organization like at that point in time?
Sure. I mean, we were pretty hierarchical. We had a pretty set structure, and really to influence change, you had to start with senior management. We were kind of in the transition of, since that time, we've gone through a lot, kind of a number of CEO changes. We've had the current one now for, 4 going on 5 years, but in that time, it also provided the opportunity to be able to influence that change as well a little bit, right? And try to get it so where the mindset of ERM was these people can help, right? Because we always start with engaging with members of management and the people who really influence change in their departments and say, what do you view as risky? Right? Like, I don't want to take my preconceived notions into their department and say, well, have you thought about this or the other thing, right? Like, you tell me what keeps you up at night. Tell me what your challenges are. Tell me what your struggles are. When you look 12 months from now, what do you think is going to be a challenge for you? And right, you have that discussion with someone who's really deep in operations versus someone who oversees balance sheet management. Those are very different conversations, right? But leverage that. And then as you learn from that, you can start to provide a feedback loop into that and say, well, have you thought about this as in relation to that, right? I hear this concern. How are you measuring that? And then you start to understand how they're thinking and perceiving of risk.
Well, and it starts there by, as you said, going out and getting that line of communication in place, right? You have to make the effort to go and build that channel, build that relationship. So it sounds like communication has been a really crucial factor for you as you've leaned into this area.
Yeah, absolutely. And it's really important to tailor communication to the group, right? So if we're communicating with the board or our CEO or the ERM committee, it's a lot more formal, right? Like, we have presentations, we have, right, things that are prepared in PowerPoints and everything else. If we're meeting with management teams, it's very unstructured.
Well, that's right. Knowing your audience, but and if you engage them correctly, you're going to get a different type of dynamic and give and take. And I think it goes back to your earlier point, right, of the value add relationship, right? It's not you coming in to say yes or no necessarily, but it's you coming in to foster the thinking and the collaborative problem solving there by saying, look, we're trying to open up a line of communication here. We're not coming in with a mandate per se.
Yeah, absolutely.
What challenges have you seen, right? You talked there a bit about tailoring the communication to the audience, right? The formal and structured versus perhaps the more collaborative or unstructured or informal. When you've gone out and tried to communicate and tried to build these relationships, have you encountered any particular obstacles?
Yeah, I mean, right. I think the hardest thing with any ERM program is buy-in, right? And there's a number of levels to that. It really does truly always start at the top. I'm fortunate where I have a CEO who supports the program and will forward me things that he sees as risky in the industry, or we have conversations about it, right? So you really do need that buy-in, because I can be really loud and I can put stuff on your calendar, but that doesn't mean that I have any sort of influence or that you care to listen to what I have to say, right? So having an ERM important, and the buy-in on the program is really important. It starts with the CEO, having your board as well, right? Like, we all go through the appetite statements. And I think one of the exercises for us that was really helpful is our appetite statements aren't fluffy. They're pretty detailed, right? So we have appetite statements that actually have examples. Like, these are things that would be considered to be within our appetite. And these are things that would be considered to be outside of the appetite. And we put examples, right? And what's interesting is we did that exercise probably 4 years ago and spent a lot of time going through the board with those statements. And I review them every year. And even as recently as this year, I looked at them and I was like, man, they are still they don't need to be updated. And you would think you'd have to update them more frequently, but it's not because they're so broad. It's because, like, when we talk about our appetite for taking new and emerging technologies, we talk about, right, like, we're willing to take some risks there, but we don't want to compromise the member experience. So, like, there's some back office things that I can do that push the needle a little bit, but before I go ahead and put that into the mainstream where it's going to impact our members or it's going to create friction in their experience, I have to stop and pause for a second. But that statement 4 years ago is relevant, and it's relevant today, and it's probably going to be relevant in 3 years from now. So having really good appetite statements, getting the buy-in from the board, from senior management, and that will start to trickle down to where you can start having the conversations with others and making sure that you're unlocking their value. Where do you find value in the program? How can I help you? What are you measuring as you perceive things that are risky? How do you measure that? Can I take that off your plate for you? Can I measure it for you? Right? I'll do the work and then give you the ability to see that and track it on a regular basis. And then we can touch base on it on a quarterly basis. right? Now I've assisted them. I've also met my needs, and I have it aligned with our appetite statements.
All right, you talked there about developing a set of key risk indicators, key performance indicators, something that you are then going to measure and monitor. Perhaps explore that a little bit farther. When you go down that path, how prescriptive are you? Are you coming in with your ideas there to say, look, these are our best practice risk indicators that we want you to think about, or is it more of a kind of an open dialogue, and do you see where you land?
I always start with theirs and then supplement, right? So
Yeah.
first and foremost is building the trust and extracting value, like demonstrating that I can prove value to you. So when I start with, what are you measuring? It doesn't mean that I necessarily adapt it, but I have to understand what they're doing first, right? And then theirs may be way too granular, or it may be something that's more staff performance related or accountability related. It might not be quite high enough up to kind of get a sense from an ERM perspective, but we'll talk about it and talk about, I think this is great that you measure it because it allows you to be accountable to your staff, but maybe I'm not interested in that measurement. Like, right, like let's talk, delinquencies or, special accounts, resolution, recovery type things, right? I may be interested in the delinquency and the performance of those loans and our ability to collect on them, but they may also, they're tracking, that's right, one of the core functions of their job, but they're also going to be looking at staff performance and accountability. And there's some correlation there, but ultimately, like, what do I have to bring up to the board and what's high enough level? Because they have to manage their department regardless of my presence or not, right?
Right.
So we'll find alignment on a couple of those key indicators. I'll take those off their plate and I'll say, hey, we're also, industry-wide, we tend to look at these ones. And, this data comes from our call reports, so we can standardize it, right? Which is huge. We can benchmark it, which is also huge. And what if I take these and I supplement with those like 3 or 4? Would you find value in that? And 9 times out of 10, they always find value. Most leaders, right? They find value.
Yeah.
Most leaders are never shy. If you put data in front of them, they'll love to look at it, right? It's just a matter of like, are they going to pull it themselves? Probably not. Are they going to do a peer analysis? Maybe, maybe not. But if I give it to you, you're going to look at it.
Yeah, well, and you mentioned earlier this whole point of achieving buy-in, and so if you've come into that conversation and one, you're demonstrating, right, an interest in what they're already doing, you're learning kind of operationally what is important to them, you're building trust, and then when you supplement it, as you said, right, with additional data or comparative data, right, or industry standards, you're now adding value again, to go back to that, kind of the earlier phrase of adding value to the relationship. So you're getting their buy-in because you are hearing them and developing trust, and then you're giving them something to further help them do their job. So I think that just, it goes back to the reinforcing the buy-in and the adding value there.
Yeah, absolutely.
When you also talked a little bit there about using some tools and technology kind of early on in your remarks to capture some of this. Can you talk a little bit about how important, right, systems and technology is in advancing that risk culture and getting people to kind of buy into using data in this way?
Yeah, I think, my perspective is that, right, like you don't always need a system to do it, right? It's a lot harder without it. So it's one of those things where it's probably pretty hard to start an ERM program from scratch and be like, I'm gonna onboard a system, and I'm gonna start a program, and I'm gonna get buy-in, and I'm gonna get all these things, right? Like, even if you at least just do an appetite statement, but at some point, like, these programs scale, and when they scale, they scale and they ramp up, right? And if you don't have a way to get data in to have consistent metrics, to do reporting, it just becomes a behemoth, right? So like, you can start in Excel, and actually it's really not a bad way to do it, but you have to be so high level when you do that, because you can only manage so much, right? And then, but you can start to show value early on. And then once you start to shift the culture a little bit and you get people that are engaged, and really engagement to me at that level is like, I'm enjoying the conversation. And I feel like just by even talking about it, I'm getting something. Because a lot of times we're running our departments, our day to day, and we don't think about the horizon. We don't think about the risks that are present in our day to day operations. When you start making progress there, you're going to start to get buy-in from people that are like, man, I'd really love to be able to see like regular metrics, regular reporting. What do you have? And if you're trying to manage all that out of Excel, it's just brutal, right? So we had been there. We've done some stuff in Excel. We migrated to another system, and now obviously we're with SRA. And the key things from a system standpoint that I see are, one, you need to minimize like data entry is in data management, right? Like in any organization, that's a lot of work. So if you can minimize that, standardize your KRIs around the call report data, have that baseline, right? You're always going to add in measurements that your end users find valuable, but you got to have a baseline. And then like being able to do the peer analysis, right? That stuff's really important. But it allows you to scale the program exponentially. If you don't have a system, you just can't scale it. And right now, like we measure, right, we're probably around, if I had to guess, like 60 to 80 KRIs, and we're still pretty in the infancy stages, I'd say. Because there's just so much potential to measure them and be pretty lightweight about measuring and then having things that are valuable to business owners.
When you take an organization through the journey there of moving from a concept to Excel or right any other I'll say basic tool set to then something a bit more advanced, did you see impediments along the way or challenges to get people to come along that journey with you?
One of the challenges that we had with, and I would say kind of with our last system is it was really hard. It was a great system, but it was really hard to show the value in it. I think that's key. Like ideally, your best case scenario is going to be, I have an end user that's a manager or an AVP or even right a chief or whoever, and they can go in and they can see their area and the things that they're responsible for and the metrics that we've talked about. And I can also measure how often they're going in. So one of the benchmarks that we've started to use this year, it's new for us, is to measure logins basically from end users so that we know who's engaging and who's not. And you may have great conversations and quarterly you meet, but if they never go in and log in and look at the results themselves, then I think you're lacking something, right? And we need to do a better job of when we sit down in those quarterly meetings, we know that, oh, this person's going in on a regular basis, they're finding value, or this person isn't. And then how do we start to shift that mindset? Because one of the things I was going to talk about is when you stand one of these programs up, your strategy for ERM is to obtain buy-in. Once you've done that, you're going to grow, you're going to add new positions, management's going to change, people change in their roles. So now you're maintaining the buy-in that you've established. And that's actually, like, to me, that's one of the harder strategies because it's keeping the momentum going. It's really easy to create a program like anything and get a lot of excitement about it, get a lot of buy-in on it. You have people that went through the implementation, they know the process, they were part of the risk appetite statement development. But now you're 2 years, 3 years out from that. How do you maintain that, right? That interest in the program? And that's really hard to do. So I think by being able to show that to people and hey, like log in, right? Look at it. You own this. And really pushing that ownership to the business owners, I think is really crucial to a successful program.
That's an interesting point there about the new shiny object, right? People can get excited, right, with the new toy, right? The birthday present, whatever it is, right, that gets their attention, right? The new release, right? The music that comes out and everyone's all juiced up. But the key is, does it have staying power? And can you get it to really be something that is part of the business as usual activity for folks, and making sure that there is it becomes something that is delivering value in their day-to-day lives, and right, whether that is through data getting pushed out to them or you as a risk team going out there and proactively sitting down with them and having discussions, but they have to get value from this, otherwise it's just going to regress. So I do think the other element of that is there's a cultural aspect where, right, you've done this work to get the culture to progress, and you've got to make sure that this is part of your your quarterly business briefings or your monthly operating committee meeting or your weekly stand-up or whatever it is. I know we've got a bank that we work with in Tennessee, and they use a dashboard at their weekly operating committee meeting. They pull it up right there, and it's just become part of their daily lives, right? It's not something that sits on a shelf. And look, people need to be updating data and using it, as you said, logging in and actually updating their risk improvement activities, right? If they're not updating it and using it, you're going to go in there, you're going to look at the dashboard. There's nothing updated, nothing changed. So there's no reason to log in at that point, right? It becomes a bit of a self-fulfilling prophecy.
Yeah, absolutely.
I think maybe the last question I have for you is a bit about, right, what does the future hold, right? So you've done quite a bit of work to get, this risk culture in place, right? You've talked about buy-in and systems and utilization of data. But if you look ahead and you see, challenges and opportunities on the horizon, and undoubtedly there will be unforeseen ones. But do you have a vision of where you want to take the risk program from this point forward?
Yeah, I mean, for me, it's right. Like, this may sound silly, but it's staying relevant, right? I mean, it really, and this is one of the things that I learned early on in internal audit is, first of all, in internal audit, no one wants you there. Right? You're an interruption to their day. It's just the reality. And I've just made it a mission to never be put in a position of any role, whether it's internal audit or ERM or, these back office kind of bureaucratic type structures, is to be in a position where all I do is check a box for a regulator. Like, if we don't add value, we're doing it wrong, right? So just staying focused on the stakeholder, it doesn't mean that we don't have a risk to play, or sorry, a role to play in helping to manage the risk. We absolutely do, but you got to understand the environment that you're in and the leaders that you work with and your peers, and say, like, where is their risk appetite, right? Are they super risky where I try to keep them in check? Or are they trying to manage their numbers to appease their CEO and their managers and management team? And they're kind of risk averse because they don't want to, right? Yeah, I can maybe get a little bit of, ROI from this, but I also take on some risk. And how do I help them measure that and encourage them to take more risk? And that's really been our journey over the past 4 years, I would say, is encouraging that. And I don't know where that goes going forward, but I think we stay relevant by staying focused on your stakeholders, right? You have the tough conversations and you've got to have them. But I'll be honest, in the 4 years I've been doing this and kind of building this program out at Service, I haven't had to have a ton of them, right? Like, and I've had some with our CEO around, right? Like, oh, we kind of knew this would happen, and we had modeled some predictions and all that, and either went inside or outside their prediction. Like, things happen, but what you're trying to do is take measurable approaches to risk. And as long as you do that, I think you're relevant. As long as you meet your stakeholders where they're at and you allow them to feel confident in making risk trade-off decisions, that's how you add value, right? Take that burden off their plate. Like, if you're looking at, hey, we want to expand, right, our lending portfolio, or want to do something with deposits, or it's going to have implications to the frontline staff. It's going to have balance sheet management implications. Like, right, the implications are broad, and people always think about their one area. How does it impact my area? And if you can have the broader conversation in the lens to say, it impacts all these things, but you know what? Everyone's comfortable with it. We just have to do A, B, and C to make sure that everyone's in the same page, and we're good and we can move forward. And you know what? There's a really high likelihood of success here. And we're going to track it, we're going to measure it, and then we're going to sell the success. So the next time it comes around, we can say, remember when we did this and we knew we were taking this trade-off, but it was successful, and we're going to do it again, right?
You've triggered a thought in my mind. We've talked about this whole concept of risk and strategy being two sides of the same coin.
Absolutely.
And right, if you have a view that you're talking about here, you've got a portfolio, right? You've got two things that they actually might be offsetting one another in terms of risk, right? So if you look at something in isolation, right, it may seem overly risky, but if something else is being done that is a potential hedge against that, then at that portfolio level, all of a sudden, right, strategically, right, you're no more risky, right, but you're able to pursue kind of two different opportunities. Or maybe you are taking on a bit more risk in order to capture a bit more return, but you're on a risk adjusted basis, that makes sense. So I think that the concept of measuring it, tracking it, reporting back on it, right, and evaluating the the strength of that decision making, and then looking at it in a in a portfolio level there, it that truly is the value add that you talked about at the outset. And so the best, certainly the best way to stay relevant, right, is if you are helping the organization make strategic decisions, right? You're not a department of no, you're a department of how do we do this instead.
Yeah, absolutely. Right.
Ty, we covered a lot of ground here today. I've got a couple of pages worth of notes from, right, I'll say kind of starting from the end of the beginning, right? Staying relevant, remaining in the conversation, and encouraging the organization to take prudent risks and quantifying that, and going all the way back to the beginning of how do you get buy-in and moving from, right, I think you used a great phrase there of, right, not wanting to be a distraction or impediment, right? Is that audit person coming in the room, but rather someone that is facilitating a more constructive, thoughtful conversation, one where you're truly adding value, and getting the organization to come along this journey, if you will, and become a bit more risk aware, risk tolerant. I think there's a few other things I'd like to unpack maybe in a future conversation. I think that some of the things you said about your risk appetite statement persisting as long as it had, right? There's some interesting things to come back to there, but you've given us a great chunk of content here today. Appreciate the thoughts. And hopefully this helps people think a bit more about their cultures of risk and what do they need to do to continue to strengthen those. So Tyler, thanks for the time today. We appreciate it.
Yeah, absolutely. Thanks.